Hi, and welcome to a new video with Athena Quant. Today, we're going to break down one of the most powerful tools in all of finance. I'm talking about regression analysis. Seriously, this thing is the engine behind so much of what quants do, from figuring out risk to, actually finding an edge.
I mean, this is the big one, right? It's the question every single one of us asks. When the market has a good day, what does my stock do? Does it go up even more? Does it kind of lag behind? Or does it just do its own thing? Well, regression gives us a really solid, systematic way to get to the bottom of that.
So, when you boil it all down, regression is really just about one thing: finding the best fit line. You see all those dots? Imagine each one is a day. On the horizontal axis, you have the market's return, and on the vertical, you have your stock's return. Regression's job is to draw the one single straight line that cuts through that cloud of points as perfectly as possible. That line tells the story.
All right, here's our game plan. We're going to start with that best fit line. Then we'll get into the good stuff, alpha and beta. After that, we'll ask, hey, is this model even any good? We'll run some crucial checks, and finally, we'll peek beyond just the market. Okay, first things first, let's talk about that best fit line and how we actually go from a mess of data points to some real market insights.
It all boils down to this little equation. Looks a bit mathy, I know, but stick with me. Y is just our stock's return. X is the market's return. The whole magic trick is finding the perfect values for beta 0. That's our starting point or intercept. And beta 1, the slope of the line. And we find them by minimizing those little epsilon things. That's just the fancy term for the error, or the distance from our line to every single data point.
All right, so now we get to translate that math into the language of finance. Because that slope and that intercept, well, you've definitely heard their names before. They're beta and alpha. So beta is literally just the slope of that line we drew. That's it. And what it tells us is absolutely crucial. How sensitive is a stock to what the overall market is doing? It's our #1 way to measure market risk.
And this is where it gets really practical. You can literally classify stocks with this one number. If a stock has a beta of exactly 1, it moves pretty much in lockstep with the market. If it's over 1, think of a high-flying tech stock. It's more volatile, more aggressive. And if it's under 1, like a steady utility company, it's more defensive. Super useful, right?
Okay, and now for the one everyone's hunting for, alpha. That's our intercept, remember? Beta 0. Alpha is what's left over. It's the performance that can't be explained by the market. So if a stock has a positive alpha, it means it's delivering returns above and beyond what its risk level, its beta, would suggest. It's the secret sauce.
Okay, so we've got our alpha, we've got our beta. Great, but how good is our model actually? How much can we really trust these numbers? That's a super important question we have to answer next.
And that's where a metric called R² comes in. It's just a number, from 0 to 1, that gives us the answer. It tells you, point blank, what percentage of a stock's moves can be explained by the market's moves. A high R², that means the market is pretty much driving the bus.
So take a look at this. An R² of 0.70 is a perfect example. What this is telling you is that 70% of whatever this stock is doing day to day, it's because of the overall market. The other 30%? That's all company-specific stuff. A great earnings report, a new CEO, a product recall. That's the part of the story that's unique to the stock itself. But gotta give you a quick warning here. R² has a little problem. It's a bit of a people pleaser. It will always go up if you throw more things in your model, even if they're totally useless. That's why the pros tend to use adjusted R². It's smarter. It only goes up if the new ingredient you added actually improves the recipe. It's way more honest.
Okay, now for a part that, honestly, a lot of people skip. And they really shouldn't. It's like a pre-flight check. Before we actually trust anything our model is telling us, we have to do some quality control and make sure we're not breaking any fundamental rules.
See, for a regression model to be legit, it has to follow 4 basic assumptions about its errors. The residuals we talked about. The relationship has to be a straight line, the errors can't be related to each other, their spread has to be consistent, and they should look something like a bell curve. These are the ground rules.
Let's just take one of those as an example. Homoskedasticity. Yeah, I know, it's a ridiculous word, but all it means is constant variance. What you want to see is the picture on the left, a nice, random, boring cloud of errors. What you don't want to see is the picture on the right, where the errors are fanning out and getting bigger. That's a big red flag that your model is less reliable in some spots than others.
So, up to this point, we've only talked about one thing influencing a stock, the market. But you and I both know that's not the whole story, right? Of course not. So, Let's upgrade our toolkit.
This is where multiple regression comes in. We can build way more sophisticated models, and probably the most famous one ever is the FAMA French three-factor model. This thing was a complete game changer because it proved that other big systematic things, not just the market, help explain why stocks move the way they do.
So what did they add? Well, they kept the market factor, of course, but they added two new ones. First, a size factor. This captures the fact that historically, smaller companies have tended to outperform bigger ones. And second, a value factor, which captures the tendency for cheap, value stocks to do better than expensive growth stocks over the long haul.
So let's do a super quick recap of the big three. Beta, how much does your stock move when the market moves? Alpha, is your stock outperforming what its risk level would predict? And R squared, how much of the story does your model actually tell? I mean, these three numbers, they're really the foundation of so much quant analysis.
You know, it's so important to remember this quote. All models are just approximations. Regression is an unbelievably useful tool for finding patterns and getting a handle on risk, but it's not a crystal ball. It's not going to tell you the future with perfect certainty. It's a map, not a time machine.
And that really brings us to the final question, the one I want to leave you with. Now that you've got this framework in your head, what other factors could you use to explain what's going on in your own portfolio? Beyond just the market, what really drives your returns? The possibilities really are endless.